Hello, guys. What is happening? And welcome to tonight's live stream. So, I wanted to go through something today, which is the bond market, what's going on, and really explain how people don't realize that this is like the collapse of the economy. Just people aren't realizing why yet. And I'm going to try and explain how it all works because got asked a question on Twitter, like, what does this mean when I put all this stuff up about what's happening in the bond market? And it's a good point because I know a lot of people who just find this sort of thing boring, don't understand it. But nevertheless, it's an important thing to understand because you can really understand what's going to happen going forward by looking into the bond market. And really, I'm not so concerned about real estate. I'm not so concerned about the stock market right now. It's the bond market which I'm really paying a lot of attention to at the moment. So we're going to go through it, and that's kind of why I put the title as I did for this video. Forget real estate. Canada's economy is absolutely screwed and unemployment is going to soar. And we're going to go through exactly why that is, how it works, how everything is tied to the bond market. And yeah, anyway, let's dig right into this. So first of all, I'm going to pull up a chart, which is a government bond. So this is one that I posted on Twitter because I thought, you know what, this is just insane, the level that this thing has got to now. So this is a 2-year government bond. So why am I bringing up a 2-year government bond? So basically, a 2-year government bond is just government debt. You're just essentially, if you're buying this, you're buying government debt. So it's essentially setting the risk-free rate because the government hasn't defaulted and is extremely unlikely to default. So that's why government bonds kind of set the risk-free rate of interest. So that's why like a 5-year fixed rate mortgage is always going to be more than a 5-year bond yield, because who is going to pay for a mortgage-backed security that yields less than a government bond where they're guaranteed to get paid? So if we look at this this 2-year government bond, what I really want to show you here is if you look at this thing has just gone absolutely parabolic. Like, we haven't seen a move like this in the past 22 years. And we haven't seen a move in inflation like this in the past 20, 30, 40 years. But what people don't understand is the ramifications of this. So what you're seeing on the chart here is basically the yield. So I'll just show you. So basically, this is where we're at right now, around 2.5% for this 2-year government bond. So if you're buying that government bond and you hold it for the 2 years, you're going to get paid 2.5%. Now, the interesting thing is, if you look back historically, this is a monthly chart. So if you look back historically, and we go all the way back to 2008, that is when this bond actually was at this level. Not since 2008, before the financial crisis, and the whole monetary system as we knew it changed completely from that point. So the fact that it is now at this point is concerning, and it's concerning for a reason. So that is the risk-free rate. So you know everything is going to be priced higher. Every other form of debt is going to be priced higher than the rate on this. So when you see banks that are offering, variable rate mortgages, which are less than like a 1-year bond, for instance, they're taking on incredible amounts of risk in order to sell that mortgage. And you've got to ask yourself the question, why would they do that when they can just buy a government bond? Is it because they're then creating derivative products from those mortgages? They're slicing them up, selling them into all these different things and packaging them off to investors. That's exactly what happened in 2008. Essentially, the mortgage-backed security got turned into 100 different things and sold 100 different times. And that's why they were so lucrative. Everybody wanted to sell mortgages. They didn't want to sell government bonds or any of that stuff. So you have to sort of ask yourself that question, and that is happening in the case. Well, it was happening. I'm not sure if it's happening now, but it was happening for a long while with First National Bank and Equitable Bank specifically. So, anyways, we're going to pull this back up, and then I'm going to show you something which you need to see. So if you figure that 2.5% is the return that you're getting for that government bond, then we need to know, and we know that this government bond is now at a level that we haven't seen since 2008. We now need to know how much debt is in the system since 2008. How exposed are corporations? Obviously, if they have less debt than they had in 2008, then it's not really going to be that much of a big deal. This is where it gets seriously concerning. And I mean, this is just the Canadian economy in a nutshell, really. Just a joke, a laughing stock. So anyway, if you look at this chart, this is Canada private debt to GDP. And as you can see, the debt has absolutely risen and exploded since around 2008, funnily enough. So the debt bubble really started around 2008, and now we're over 300. So the amount of debt in the system has gone up like over 35%. And that is incredible amount of debt. So now we're going back to pre-2008 interest rates for a lot of this debt that corporations have. How is that going to affect them? And that's really where the economic collapse that I'm referring to in the title of this video. It's no understatement. It's no understatement what's written on the artwork for this video. It is completely screwed. Like, there's no way out of this, and it's not going to happen instantly. You're going to start to see businesses fail. You're going to start to see businesses cut back. You're going to start to see unemployment rise. I think we're going to start to see unemployment rise by the summer, and then it's going to keep going up from there. I think we're really scraping the barrel in terms of full employment, and the economy isn't booming, and we're supposedly at full employment. So if we're at full employment, why isn't the economy booming like never before? And it's really not. So the thing is, this is incredibly important. Everything is based off these government bonds. The debt market, the risk rate is all based. Now, here's something that you need to know as well. If you're a bank and you're lending out cash, and you look and your government bond is returning like 2.5% or whatever, you're not going to price your interest rate below that bond. However, you know that the higher you price that interest rate, the more likely a person is to default on that loan. So the risk goes up. So as interest rates rise, the risk premiums rise too, because there's more risk. More people are going to default. More people are going to go bankrupt. That is a result of rising interest rates and the debt levels we have. We have massively high household debt levels and corporate debt levels. So let's switch over now to household to disposable income, which is the best measure really, because it really shows. So basically, I think the dips here are actually to do with the stimulus money that was pumped in. So everybody's income shot up, but it was all really fakery, so a manipulation. So 2020 take with a grain of salt. But as you can see, we're well over now what we were pre-Cerveza sickness. So you know that it's not just the private enterprises, it's not just the corporations, it's the households too. And let me tell you, there are loads of households and businesses that hold variable rate debt. It could be on a line of credit, business line of credit, could be on a home equity line of credit, and the list goes on. And they're really completely screwed. Like, I mean, to say that the central banks have their back up against the wall is just a complete understatement. They have created the biggest recipe for disaster the West has ever seen, like in the past 30, 40, 50 years, really since the Great Depression, because the only way out of this is tough. There's no easy way out of this. There's no saving grace. There's nothing that's going to cure this. Inflation isn't just going to magically go away. So it's kind of insane. And let's go to the 1 year government bond, because the 1 year government bond is even shorter on the yield curve. So you're talking even more variable rate debt. Now, if you think about corporations, a lot of them take it out on the short term because the interest rates are so low. So in 2020, what a lot of corporations and businesses did is they say, hey, you know what? Let's do a stock offering. We'll buy back our own stock and we'll just sell some corporate bonds and we can sell them at a ridiculously low interest rate. Well, now everyone's selling those corporate bonds. So the interest rates they're paying are going up. So you're going to see a reverse of that. And that really pumped up the stock market for a lot of different companies. And that the corporate buybacks was many different companies, right? It was a lot. So you're going to see a reversal of that. They're going to have to start selling stock to cover the payments for these bonds. You know, and it's also going to lead to more inflation because certain businesses are going to obviously try and pass that on to the consumer if they can, which most can't, let's be honest. We've already seen with inflation and the input costs for businesses and the fact that the consumer price index and different raises in prices for different items haven't been as substantial as the input costs have risen. So that's kind of an indicator that those costs aren't being passed along to the consumer fully. So somebody is eating up the difference in the margins. And it's really interesting, I find. So, you know, the interesting thing as well, which I think is just kind of crazy, is when I look at the bonds and what they're doing. So like if we take this 2 year, for example, sat around 2.5%. It's at the highest level it's been since 2008. If we flick over to this, which is a iShares Canadian bond ETF, you can see that this thing, which is just full of government debt, essentially, in Quebec province debt and probably many other different things. But the yield on this thing is around 1.5%. Like, who on earth is going to buy that? Like, and that's the thing, that these corporate bonds have a lot longer way to sell off than they currently have. I mean, you've currently got some of the bonds trading at a lesser yield than the government bonds. And who is more likely to default? You know, I just find that insane that there's that such of a disparity. But if you look at where this bond is on this chart, and I know it's kind of small, but you can see it's sat at 23.82. So if we go back to October 2018, October 2008, it was around 1877. So I'm guessing the yield would have been around 3 or 4%, something like that. Right now, it's at 23.82. It's got a long way to go down. And another one, this is a BMO. This is triple B rated. It's not even, this isn't even good. This isn't even the really good debt. This is triple B rated debt. So that means it's worse, like triple A. I can't remember all the ratings off the top of my head, but it's pretty good. But it's still not amazing as well. You're going to have a lot of dodginess in there as well. But the top holdings in this are like Bell, Bank of Montreal. You know, these are all people that are obviously going to pay the bills. But then there's going to be a lot of other ones, small businesses, not so much. But if you look at this thing as well, this thing isn't even, it's trading above its 2020 low. So these bonds have a lot longer way to go in terms of selling off. And I'm not sure that people really understand what that means. Like, government bonds, they are setting that risk-free interest rate. It doesn't matter if you're in the UK, the United States, wherever you are. And they're all rising in all the Western countries. They're exploding. In New Zealand, they're up. In Australia, they're up. And even in Europe, they're up, despite them vowing to not raise interest rates. So it is happening. The interest rates are going up. The market is pushing the interest rates up. And what's interesting is the correlation between the stock market and the bond market has decoupled completely. Now we see days where the bond market goes down, yields go up, and you have rallies in the stock market like we had today in tech, for example. But if you look at the COT data, you would see that a lot of institutions are using the buy up today to sell short into the NASDAQ and the S&P 500. So that tells you what big money is doing. Big money is shifting to the short side. They're not shifting to the long side, and they know what's coming too. So the thing is, with all the yields that are rising right now, what's going to happen for the banks are the velocity of loans is going to slow down. So loan growth is going to slow down. Their forecasts are going to drop. And that's why I'm looking to enter into some short positions potentially, and other different options that I'm planning for different Canadian banks that I just believe are completely and utterly overvalued. And they're going to have to cut their growth forecasts completely. And the thing is, like, they're not going to be selling as many loans. And what people don't understand, like, a lot of people just have this old mentality. The whole financial system changed in 2008. And the thing is, most of the bank's revenue comes from selling loans. It doesn't come from like interest, like you depositing money into the bank anymore. That's not the way it works. So when interest rates rise, that negatively impacts the banks because they're not selling as many loans now. And that's the majority of their business, not made off the interest. Now, another thing that I just want to make sure is the thing is, when you think about loan growth is highly correlated with what asset prices do, funnily enough, because it's essentially credit growth is what these asset prices are correlated with. So if the loan growth, the velocity, if everything's slowing down, that's not a good sign. That means liquidity is drying up. That means money, the availability of money is drying up. Now, we'll just like talk about price anchoring real quick. And the easiest way is real estate, because a lot of people can relate to this. But price anchoring essentially is real estate. So in real estate, basically, let's say a guy, Joe Blogs or whatever, goes to sell his house, but he's been watching the local real estate market. His neighbor sold in February for like 700,000. And his realtor comes in and says, you know what, you got to list at 600,000 because the market's changed. And he's like, no, I want that 700,000. So he's trying to constantly get this 700,000. He's got the number just stuck in his head, and that's a price anchor. People have got this number stuck in their head, and it takes time for that to kind of undo itself. So basically, in real estate, I don't expect there's going to be much action in terms of price volatility for the next couple of months. I think it's going to be, fairly flat. A lot of markets declining, but not substantial declines, although there have been substantial declines in small markets which were pumped up like penny stocks. I saw Ajax is down something like 20% in a month, or year over year. I didn't really look too much into that data. But the thing is, with that all happening, with the loan velocity slowing down, when people start getting laid off, because this is happening, because the company, the business, you're the business owner, your costs of servicing that debt have gone up. You can't pass that on to your consumers. What are you going to do? you're going to have to start cutting your overheads. You're going to have to start laying people off. So growth works in reverse then. Instead of growing, you're contracting. Which are the companies that are going to be most affected by this? Tech companies, because most tech companies, they don't even turn a profit because they're entirely focused on growth. So they're extremely exposed to the debt market. And that means that a lot of tech companies are destined to go bankrupt. And, it works in reverse. Like the thing is, there's no bright lollipops and sunshine way of describing this, that everything's going to be okay, guys. Don't worry about it. Like, no. People need to prepare and get this in their head. They need to start thinking, what if I lose my job? Can we afford a house payment on one salary? What's going to happen? Like, is my job secure? Is my job in finance? Is it somehow tied to real estate in some way? I mean, think about it. Lawyers, there are plenty of different professions that you wouldn't think are tied to real estate, which actually are. So you really just have to think about that. And it's got to be something that people think about. And now is a good time because there's still jobs out there. Like the employment rate is high, the unemployment rate is low. So it's a good time to be looking around to switch up your career or whatever, if that's what you want to do, and look for something where you're more secure. Because at the end of the day, like there's no good outcome from this. Like there really isn't. And the stock market, the fact it's decoupled with the bond market, that really shows me that like, we're close to the end zone, because that's not a good sign. The stock market should be correlated, especially the tech stocks like the NASDAQ should be correlated with the bond market, because a lot of those companies are losing money. And then you got to think about, like, okay, so tech, like what are the companies that are going to fall the most? And I said back in January about Netflix, they just came out with their earnings. And the reason, sometimes these things are so simple, people think, you know what, there's no way it can be that simple, Luke. But yes, it can. Because I was thinking about how can we cut costs. It's not necessarily because we need to cut costs, just how can we cut costs? Because things are going up in price. We just want to save a little more money or whatever. And how can I cut some things out? And I always do it every single year. I go through every single thing that we have and go, do we need this? Can we cut this? And we cut Netflix was one of the things that we cut in January. So Netflix, I thought, you know what? A lot of people are going to cut these subscription services like Netflix, Spotify, because they're the easiest things to cut and get rid of. Like if inflation's going crazy like it is. So back then I was like, yeah, Netflix is destined for the can. And here we are today. It's down 25% and it's now at pre-Cerveza levels. So the stock is completely reversed. The bubble has burst in Netflix. And now it's back at the levels in 2019. And a lot of different companies are going to do the same. For example, Tesla is going to do that at some point, because nobody is going to be going to buy expensive electric cars in a recession. It's just not going to happen. So as soon as they start to lose growth, guess what? Down 25%, down 30%. So this is going to happen. And this is the tech bubble collapsing. And, if you go, there's a great video, and I actually think it's a Canadian YouTube channel. And it's, I forget the name. It's like the Plain Bagel. That's it, the Plain Bagel. They have a great video that explains the dot-com bubble, I think, in 4 or 5 minutes. And you should really look at that, because you'll be like, whoa, like that's like today. So it's, let's see what you're saying about in the comments here. So Mighty Motive 1982 says, Did that come up? Oh, yeah, it did. Just slow. I'm a truck driver. Trucking has slowed 30% in America and Canada over the last month. You can't find this info in Canada. Why? Must be misinformation. Wow. So, I mean, wow, that does not sound good. Why has it slowed? Oh, yeah, that's what other people. Greg's thinking exactly what I'm thinking. Why has it slowed? So higher costs, less demand by consumers. Figure it out. So yeah, I mean that makes sense, but still, like 30% drop in trucking is a massive, massive thing. And you know, one thing I can speak a little bit because I know somebody who owns a trucking company and they can't get the drivers. I've mentioned this in another live stream. I've said like they're having trouble getting the drivers. They've got 3 trucks, I think, or 2 trucks. I can't remember. But anyway, he said there's something like over $1 million a piece, and they're just sat there because they can't get the drivers. So you know what? It's just the whole fabric of this economy is just falling to pieces. It's absolutely shattering, and just nobody wants to talk about it. And a lot of people want to look the other way and say, "Oh, it's sunny today," and it's not. It's snowing outside, by the way. But anyway, a lot of people want to look the other way and just hope for the best. It's not going to work. Like you got to face up to your decisions and take responsibility. You know, if there's one thing that people don't seem to do in this day and age, it's take responsibility. Everybody wants to blame somebody else for something they did. You know, it happens a lot here on YouTube as well. Like take ownership of the decisions that you make in your life, because you got to take control of your own life at some point. Don't start blaming other people and saying, "Oh, you know, I wish I did this, I wish I did that," or whatever. It's just too bad. So what else are we saying? David's in the house from. Are you in Vietnam, David, or are you in New Zealand at the moment? So what else we got? That's another part of it. Higher fuel costs. Oh, mighty motive has gone now. Ramping up fixed cost fuel, rent, mortgage. Hey, great shout out for Joe Blogs. He's got a great channel too. Rising rates also. If you've got anything to say, we've got nearly 50 people in the house tonight. If you've got a question or anything like that, just stick it in the comments and I'll try and address it. Rising rates also pushes more people down the price curve, which arguably solidifies the price floor wherever it is. Yeah. So I mean, I'm guessing you're talking about real estate there. So yeah, but it's interesting, you know, the first thing that happened, if you just go back, all the data is online. But the first thing that happened in like 2005, 2006, when the real estate market peaked, and really if you're in Canada, like you're focusing on Toronto and Vancouver, you need to be comparing it to places like California, Phoenix, places like that, because it'll be similar to that. And you look, and basically prices were kind of flat. You know, they were up and down from 2006 to 2008. But the thing was, the sales seriously dropped off when those interest rates started going up in the US. The sales started dropping off, and that loan velocity stopped. And then those banks suddenly weren't making those huge profits anymore. And suddenly the defaults started rising. And guess what? They did not have enough risk premium to pay for it. So essentially, it was just a recipe for disaster, all the mortgage backed securities. But what people forget, and we've covered it on the podcast before, and if you haven't checked out the podcast after this, go to the link in the description, check it out. It's one of the earlier episodes. It's titled something like 2008, it was all wrong, or the narrative was wrong, or something like that. I did it quite a while ago, and it's not on this YouTube channel. But listen to it, because I go through the data which was saying that it was mostly people with good credit. It was just investors and speculators that were foreclosed on. It wasn't the subprime crisis that everybody thought it was. And why would they want to label it as a subprime crisis? Because the thing is, if it's everybody who is the bank's customer, like the prime customer who's got good credit and everything like that, then people are going to be asking why did that happen? How did the banks allow that to happen? How did they allow people to get so over leveraged? Oh no, it was the poor guy, it was the immigrant, it was whatever. Those are the real cause. And you'll see the same thing in Canada. I mean, they've been building this narrative up now for the past 6 years of immigration's causing the housing market, immigration. I put out a great tweet, and we'll go to Twitter because I thought this was fantastic because it was so true back then. And it just kind of, in a different market, puts it into perspective for Canadians what can happen. So if I go to my Twitter feed here, I'm going to pull this up. Oh, come on. Here it is. Okay. So I put out this tweet yesterday, and you can see, like, so this is real residential prices for the UK for commercial real estate, residential real estate. Obviously, that's what it says right there. And this is adjusted for inflation as well. I want to be clear because I'm only concerned about real adjusted for inflation prices, not nominal prices. If inflation's really high, you can have nominal prices going up and real prices going down. So this is really interesting. So when Romania and Bulgaria joined the EU in 2007, as you can imagine, many speculated on the fact that thousands of people would come to the UK. And the data actually backs up that thousands of people did come to the UK from Romania and Bulgaria. So they weren't wrong. Lots of people did come from Romania and Bulgaria. Did that stop real estate collapsing in 2008? We'll take a look on the chart. Many did move to the UK and immigration served. So if you look at this chart, you can see right here, I've pointed out where Romania and Bulgaria, they joined the EU, and then you literally had like a year of price growth, and then the price absolutely cratered. The thing is, the same holds true for Canada, because lots of people like to speculate on, oh, it's immigration that's causing the housing boom, and oh, it's supply, we don't have enough homes. Like, it's all false. Like, it's speculation. It's rampant speculation. That's what causes it. But then you have to ask yourself the question. You have to backpedal and go, okay, if it's rampant speculation that's causing the housing market to boom so much, how are the banks allowing this to happen? Aren't people getting over leveraged? And then when you start to dig into that, you find out, yes, they are. They're incredibly over leveraged, incredibly exposed to rising interest rates and the rest of it. And that's just the problem. So it's going to be like a real wake-up call when this happens and people realize all these stories, and they really were just stories that were told, were all just fiction. They were just fiction. So it's kind of insane, really. And I think it's just mad that people, don't think about it this way. James G, a new guy. I haven't seen you in the chat before, but nice to have you here. Luke, check out Yaron Brook. He is a capitalist. Let me write that down so I can check him out. Yeah, I'll definitely check him out. Thank you so much for the $2 super chat, my friend. So Ukrainian immigrants are arriving with bags of money to buy for a townhouse for 1.1 million in the Western tundra. Yeah, there you go. Yeah, there you go. Exactly. I'm pretty sure that's sarcasm there. But what's really interesting is that, like, when it comes to what's happening with Russia and everything like that, I don't support the war or anything like that. Just want to make that clear. But like, if you think about how people are hating on Russians right now and how the media has kind of let that rip and just say, "Oh yeah, it's fine to hate on Russians." And I was even speaking to my mentor who's Danish, and he was basically saying that he was in a hotel in London just the past week, and he was speaking to this Russian guy, and he was saying, like, the looks he gets and everything like that. Although I'm not sure how people differentiate between Ukrainian and Russian because they speak the same language. They're incredibly, like, I'm not going to get into that. But anyway, but then the Chinese, oh yeah, Chinese people just come over here despite what's happening in China. I think what this really shows is just how broken the government really is. And this is really why countries like India are essentially becoming more neutral. And a lot of countries are stepping back and going, nah, we don't want to stand behind the West because the West they're hypocrites. They're total hypocrites, which the West is, the Western government. But the thing is, you can't direct hate to any of the people because it's not their fault that a tyrannical regime does what it does. And we have a tyrannical regime here in Canada, believe it or not. People just don't want to wake up to that fact. They want to live in the rosy world. But the thing is, like, if you look at what's happening in China, like, that is huge. Like the genocide that's happening, the Uyghur people. But no, we're not going to look at that. We're just going to focus on Russia and Ukraine. Forget that. Chinese people just come over here, and nobody's saying anything about that. And I'm not saying that either is good. Like, directing hate at anybody is just not right. I'm totally against that. But what I'm saying is, how is it justified, and how are they letting people do it towards Russian people, but then Chinese people, it's like, yeah, you know what, just come over, everything's fantastic. Like, I mean, it's just ridiculous. The hypocrisy has got so blatantly in front of people's face. I just don't understand how they can even read the news with a straight face. And it really shocked me. It really shocked me when I went back home to the UK and I saw all the virtue signaling about Ukraine in the UK, because a lot of people, it's just what they read in the news. Like, they don't, it's just so crazy. And you think about, like, I think it was the London West End were banning, like, this musical which was by Russians. Like, how is that? How is that, like, I mean, that is literally racism, I'm pretty sure. Like, it's just like, but yeah, I just don't agree with any of it. But I don't know how we got down that garden path, but we did definitely get down there, didn't we? But anyway, I said I was going to refrain talking about that. But I wanted to see whether, oh yeah, so this is what I put about the corporate bond ETF and everything like that. But the thing is, people just don't understand. They do not understand the significance of this 2-year bond now taking over to pre 2008 levels, like before the 2008 financial crisis. People don't understand what that means. Like, that is game over. Like, it is game over. If this sustains, if this goes even higher, like, can you imagine what's going to happen? It's absolutely crazy. Alex, so we got somebody in from Russia. The algorithm obviously connected us. We got a lot of new people in the house tonight. Hi, people. Hello from Russia. You are right. Not all Russians support war. Sanctions hit simple people mostly. Yeah, that's exactly true. And I've always said, like, I stand with the people from Russia and Ukraine who don't agree with the war. What people forget is a lot of people do agree with the war in Eastern Ukraine, who are Ukrainians because they want to be part of Russia. Like, there's a whole, we could do videos on that, and I'm sure it would bore the hell out of people because people are sick of hearing about it, talking about it. But, it's just sad because I see people get misled so much about everything. And it's just like, oh, yeah, you're being told this and that's all false. And then they come out and say this, and you're like, oh, yeah, that must be right because they're on about war now. So everything must be correct. You have to read between the lines. I mean, just look at the size of the military force in Russia compared to Ukraine, and then kind of look at how the media publicizes everything. I mean, yeah, anyway, just use critical thinking. That's all I'm going to say when you read this sort of stuff. So many bad actors in most countries, compliments of dear old Schwab. Yeah, it's true. Like, we got two of those in charge right now here in Canada. We've got Justin Trudeau and we've got Jagmeet Singh, and they formed their own coalition so they can basically run their reign for the next 4 years. Basically, Justin Trudeau realized if there's a vote of no confidence, he's screwed. He would lose an election. So he thought, like any dictator, how can I hang on to power? What is the way I can hang on to power? So he made a deal with the NDP. Did the NDP voters vote for that? No, they didn't. Did the Liberal voters vote for that? No, they didn't. And it's just to keep that same dictator in charge. And I think Jagmeet Singh is just happy because he knew as well that the Conservatives would have likely won if there was an election. And he is a young global leader of the World Economic Forum. So is Justin Trudeau. So they want to keep it in the family. So it's Trader 586. My family is Ukrainian, and there are two sides to this. Exactly. Yeah. There's always two sides to every story. And that's what everybody really needs to take in and realize, no matter what you do, whether it's buying a stock or whatever you're doing, you always need to look on the other side of the coin. Anything, any story, whatever, just don't get blindsided, because you have to realize that there is a lot of alternative interests out there that want to sway you one way or the other. So it's crazy. It's absolutely nuts. But going back to economics, and I think, God, this thing is so laggy tonight. But going back to this and the private debt levels, like, you got to look at where this bubble actually started, which I find incredibly interesting. And this is what I did a video on this, so I can do a quick summary of the video right now. But essentially, the bubble, the reason why in 2008 in Canada there wasn't mass unemployment was because when credit conditions changed and a lot of banks said, hey, you need to pay back that money, they called in people's lines of credit. And a lot of businesses in the US that were overloaded on debt. If you look at the US, private debt is totally different to this. It started off before the dot-com bubble and then crashed after 2008. So basically, back then, they had a lot of private debt. So obviously, when the credit conditions change, when things change, when the banks said margin call, bring in the capital, we want the capital back because we're losing so much money now. They said, no, we haven't got it, bankrupt. And then the unemployment rate goes up, and that's basically what happened. Or they had to pay it back and then cut their overhead substantially because they lost so much money now. They couldn't grow. The growth, like I said, it goes the opposite way. It contracts instead of grows. And that's basically what happened. So in Canada, if you look at the chart, you can see that it really started in 2008. So basically how they dealt with 2008 was just by creating a massive debt bubble in household debt and private debt. But the household debt one had already started in 2002, 2003. And it's probably very similar to New Zealand. I think New Zealand, David, you may know this, but New Zealand, I'm pretty sure, has the same or a little bit less private debt. So the private debt is incredibly important because that's what unemployment is going to be correlated with. When that starts going down, then unemployment is going to go up, and that is going to start going down. It's going to start going down because people are going to start defaulting. So anyway, I think we're all good, and we've had a lot of people on the stream tonight. So thank you so much for turning up for the stream. Please smash that like button so other people see it. The stream will be on Spotify tomorrow, as per usual. Thank you, James G, for the super chat. Nice to see many new people in the chat as well. Great to see you, and thanks to all the people. Just do some shout outs real quick. So we got David, Trader 586. DMPR, Alex Grinder, Marilyn, SS, David Sutton, James G, Jasper Alberts, Mighty Motive 1982, Kevin Bridge, Greg's in the house. No, he's a regular, and David. All right, guys, thank you so much. I'll see you in the next stream. There's a video out tomorrow. See ya. Bye-bye.